about 10:30, March 30th. March 30th. All right. Should be up and running by now. All right. Well, anyway, welcome to week 2, guys, for my governmental accounting students. I did spend a few minutes before starting up here to go through and read your verses as they relate to accounting. This is the one I like. The one I always refer to. I think about accounting. As you see on my screen here, 2 Kings 22:7 says, "But they do not need account for the money entrusted them because they are honest in their dealings." So what's going on here, as far as my knowledge here, is we've got some men building a temple. And they're honest men, all right? So honest men we need not account for because we know whatever they do, they'll do it fair and there won't be any fraud, or however you might want to say that. Let me turn my notifications down. So to me, it makes me think. Well, everybody we know, everybody that we deal with, hopefully we feel are honest. We don't usually have friends that are, not honest. But ultimately, you got to think about it in terms of a little bit deeper than that. In terms of man being fallen, seeking redemption, and because all men are fallen, then essentially all men need to be accounted for, and therefore there's always going to be a need for accounting. So that's the way I like to think about it. Kind of gets me through every week and lets me know that the profession that I have got into and try to instill into some others is always going to be vital. It's always going to be necessary. Now it seems like machines are trying to take that over, but I still think there's always going to be a need for individuals that know how the system works on paper, because ultimately the computer is doing what we've always done on paper. Now it might do it better and faster, but somebody's got to know what's supposed to be happening so they can make sure that the computer or the machine's doing it correctly, right? But anyway, let's move on to chapter 7. Now, I'm not going to spend much time today here at all. It's going to be nice and short. I am going to go through some supply funds entries, which is what we call internal service fund. But chapter 7 is accounting for business type activities of state and local governments. So this is what we call proprietary funds. And within that business type activities, those proprietary funds, there are 2 types. The first type is internal service funds, and then there's enterprise funds. Excuse me. Okay, so what are these and why do we do them? Well, ultimately, the reason that these began way back when, in the whoever thought up the whole system of governmental accounting, is to improve management of resources. So the original purpose of these was to improve management of resources, all right? Now, that's the original purpose. Now, it's changed, okay? It's changed. Now, more recently, this is out of the textbook, page 260, with increased citizen resistance to increase of taxes, many governments also rely on user charges as a means of financing operations formerly financed by tax revenues and intergovernmental revenues. All right, what I'm trying to say here, even though I'm failing miserably, when you're dealing with, a city, okay, you've got your city is a specific size. It's not really going to grow. Now, there's always going to be those weird times when the city tries to annex more acreage. I know where I'm from, I always refer to Orangeburg. They may have actually done it, but right outside the city limits is where they built the big giant Walmart, because that way they weren't subject to city taxes. And I know for a long time, and it may have happened, but the city was trying to take over Walmart so they can charge taxes. But ultimately what I'm trying to get to here is is, the city's a certain size, so you have a certain tax base that never expands for the most part. Resources, you can set a tax limit. If you keep bumping it up and up and up, if wages aren't increasing higher than the tax rate is, then you're going to be putting a strain on your citizens, and then they're going to leave the city if they're not feeling that they're having enough, if they're not getting enough, bang for their buck. They're not getting enough services to coincide with the taxes being charged. And so as the government wants to expand and offer more services, they can't increase the taxes because it'll be too much of a burden on the taxpayers. So instead, proprietary funds are a way to supplement those tax revenues. In other words, a profit. If I'm saying the word profit, those non-profit accounting. If a proprietary fund, a business type fund, has essentially inflows that are exceeding outflows, then there's a net increase in financial resources, and we can use those resources for general other services. They don't have to stay in that internal proprietary fund. Now let's look at the two types of proprietary funds. Now these funds, both types, operate on user charges, but the user is very different for each fund. So when you talk about the first one, which is kind of the weird one, it's called the Internal Service Fund. Okay, now the customers to the Internal Service Fund will be other governmental agencies. Okay, so other governmental agencies are the customers of the Internal Service Fund. So what does that mean? Okay, essentially the easiest way to think about it is in terms of like a internal motor pool of vehicles. So within the city, maybe within the county, it may not be a bunch, but maybe there's about a dozen or 2 dozen different, whether they're pickup trucks or little sedans that governmental employees can use for governmental business. Okay, so these pool of vehicles, as opposed to being one owned by a certain different fund, instead they're all part of this internal service group. And if I want to use a vehicle for city business, I could essentially it's kind of like this internal service fund is acting like a Hertz rental car or enterprise rental car specifically for our government. Okay, so now with that in mind, you gotta realize the internal service fund, we kind of want to have it running at a profit. So even though it's kind of playing with our own money, there will be a markup there where they try to generate a profit to offset expenses that are incurred by the fund, whether it's paying for mechanics or paying for repairs on the vehicles, new tires, whatever it might be. So if it gets used, there's a mileage charge, and that's going to have a built-in profit. Now, in terms of these internal service funds, it can also be stuff like IT or other resources as well. But now, in terms of, I've seen this actually occurs in for-profit business as well. One of my summer jobs down in Orangeburg again was at a place where they manufacture tractors, right? I think I might have told you guys this before, but anyway, within that, inside of the plant, manufacturing plant, there was like a big caged-in area, and we called that the tool crib was what it was called. Now, it's also called a central store. And within there, we had stuff like safety gloves, safety goggles, certain repair parts, stuff like that. So it was mostly, most of the time, it was always safety gloves and safety glasses, stuff that they needed on the assembly line so people wouldn't get injured. And I worked inside the central store, this tool crib in the summer. And it's essentially an internal service fund. Now it's obviously it's a for-profit, so it's not the same thing. But if you were in charge of, assembly line number 2, if you were the supervisor and you needed some supplies for your shift, you would go to the central store, okay, tell me what you want. I would get them for you, and I would charge them to your department, and that way it was a way to keep up with the costs. Kind of like cost accounting, obviously, too, right? Now, there was no for-profit, no markup there. There was no, marketing it up to cover the expenses of the central store. But hopefully you get an idea of what I'm talking about, okay? Now, enterprise funds, in contrast, the services or the goods are sold to the general public, okay? To the general public. I've got two examples. Again, this is Orangeburg. It's where I spent most of my life. Okay, in Orangeburg, and I mentioned this before, you get the city run golf course. It's called Hillcrest Golf Course, if you want to look it up. And also the Department of Public Utilities, which is the power company. They do power, they do trash pickup, they do water, they do wastewater, okay? And I think that's all they do, which is still a lot. So the city runs the power company in Orangeburg, or actually just all the utilities. And so within the city of Orangeburg, if you, no, let's not get into that. But anyway, if you go to the golf course, you can live in the city, you can live outside the city. So really anybody within the state could go play around a golf at Hillcrest. But now obviously the power company is different. You have to live within the range of their services to be able to get those services. And I do remember that the Department of Public Utility does run at a pretty good profit, and that profit is used for other city operations. So it is profitable. I say profitable. In other words, it's the inflows are exceeding the outflows, and therefore it is helping fund other governmental operations. All right. So there's your description of the two types of funds. You got internal service, you've got enterprise, you got a barking dog. Anyway, let's talk about the statements, the financial statements that we will do. There's going to be an extra one, so that makes us all nice and happy, right? So we get to do an extra financial statement. The first statement is called the statement of net position. Okay, let me see if I can find that real quick. It's right. It should be right here. Here it is. So this is, I can't say balance sheet, but it's like a traditional balance sheet. Okay. Now, what it will have, though, because we're doing governmental, it'll have the assets plus deferred outflows, less liabilities, less deferred inflows equals net position. So it's not quite A equals L plus E. Instead, it's A plus DO minus L minus DI equals net position, right? So obviously that was a joke, but not a very good one. So that's going to be our first one, which essentially is the balance sheet. Okay, we really shouldn't call it a balance sheet, but for us, it's kind of like a balance sheet. Now this will get a little strange when we get to the equity section, because there's no real owner here, because this is a governmental entity. So there will be whenever we get down to that last part of the net position, that's where it's going to look way different than, a little different than we would in a for-profit entity. Okay. The second one is essentially again is our income statement. Okay, it's similar. Here you go, right there. Similar to the income statement of a profit-seeking business. Okay, it's going to have your revenues, going to have your expenses, and ultimately the change in net position, which will be obviously positive if it's income, negative if it's a loss. I can't say those words because it's outflows, you see the inflows or whatever. But you get the idea. It's an income statement, and here's our next one. We love this one here, right? Cash flows, right? Now, this is the weird thing here. This is a GASB requires, okay? And nobody likes the direct method, right? So, oh, come on. There was some issues with my mouse. I'm trying to be perfect. I got it that time. Hey. GASB requires that the statements be prepared using the direct method of presentation. Okay, so that's going to have cash from customers, cash paid to employees, cash paid for supplies, whatever it might be. So it won't be the change in AR, change in AP format. Okay, so that's going to be our third statement that we haven't done in the other chapters because we haven't needed to. Instead, we just had to do the first two really. Okay, now let's look. The book has, this is internal service fund, okay, the supplies fund. Hey, come here. That's Rudy. Rudy's out there barking. Trying to have class. He's giving me the stink eye too. Anyway, all right. So these entries that we're going to look at, there's also entries for like a water fund, which is kind of like the city-run water department. Water department? The water utility, I guess, if you would say, if you want to have city water. Now, where I'm at now, here in Inman, I have a well. So I have electricity that pumps water out of the ground. So I don't have city water. Now, out in front of my house, there is a city water line that I could tap into and turn the well off. Maybe one day I will, who knows, probably won't. I wouldn't know what to do with the other stuff if I did. But anyway, you get an idea. I could have city water. Maybe it's county water. Maybe it's Spartanburg County water system. I don't know. But here, this is going to be internal services, okay? So this is going to be where, kind of like, the whole tool crib or the whole central stores thing where there's a big group of supplies. Everybody needs supplies. They go to the government-run supply depot to get their supplies, okay? So the customers to this supply fund is other governmental agencies that need supplies, all right? So we're going to run through these entries real quick, kind of a look at them. I'll just say a few words about them, and then we're going to. I'm not even going to do the ones for the water fund. You can look at those on your own time. Before Wednesday, I recommend doing the Learn Smart. Okay, that way, whenever I'm going to go through some problems on Wednesday morning, when I go through those problems, you'll be much more familiar with the material than you are maybe right now. Okay, so do your best to try to get that Learn Smart done before our session. My session that I'm going to do Wednesday, probably between 10 and 10:30 is when I'll start, and it might run about an hour. Okay, now. So let's look at these entries. Now this is some post-closing trial balance for the previous year. This would be used for the statements, and now we're not really going to mess with the statements in here. So if you want to go on to, it does show the statements for this supplies fund in the textbook or the ebook. You'll have to take this into consideration when you look at those, so you know where some of the numbers are coming from. Okay. Ultimately, here's where we're going to begin. You see we've got a water fund utility is going to kind of get this thing funded, okay, with a long-term interest-free interfund loan of $130,000. And so down here you see the accounting for that, right? So here's the cash coming into the supplies fund. You've got the current portion of that loan that you're going to pay back. And then here's the non-current portion, which is the long-term, obviously. That'll be paid back in following periods, okay? And so this is how it looks within this internal supply fund, okay? We get the cash coming in, and then recording the current debt and the non-current debt, okay? Nothing hard there. Now down here in if you look at the governmental activities, this whole internal balances, this can get tricky, okay? But all this is just kind of saying we're moving money within ourselves. Okay, that's kind of what it is, right? Now, this is in previous chapters. I think we didn't have to do this because it was like a non-reciprocal payment. Now, but this one here is a loan, so it's going to be paid back, and so that's why we have to deal with this internal balances. All right. So now it says that we have we're purchasing some assets. So with this $130,000, we're going to purchase a building, which part of it's land, some machinery, and some delivery equipment. Okay, and so here you see the recording of the assets in the fund. Okay, so different from our other funds. Okay, different from capital projects as debt service, we can actually have assets within these funds, okay? And so here would be the list of the assets within our funds, okay? Land, buildings, machinery, and some equipment, okay? It's now down here under governmental activities, it's got them a little bit more consolidated. It's got the two equipments bundled up into one. Otherwise, it's the same thing. So nothing hard there either. Now, this one here does skip the whole encumbrance process. So in theory, you could have that in there when you send out the purchase orders. You can do the encumbrance, and you can reverse the encumbrance. And now we're at this point here. So we just left those two entries out: the encumbrance with the reversal. And it says here that we have invoices. Okay, so these are approved for payment. So they went through the encumbrance process, hopefully, right? They should have. And so we have invoices that are approved for payment. So we'll make that accrual. Now, inventory of supplies is a fancy way of, just saying supplies. Okay, so inventory supplies is like the supplies asset, that prepaid asset as we move them out. It's like our inventory, right? It's kind of what we're doing. We're having inventory. It's kind of like office supplies. As they're taken out, we'll subtract them. As they're sold to other departments, we'll take them out. Okay. Okay. So that's our recording of that. We've got our liability here for these vouchers payable. You've got your increase in our inventory supplies. So we have supplies ready now to dish out to other departments as needed. And then down here, what's this cost of supplies? Okay. Now, so this is where it gets a little different. Okay, so let's look at some of this wording. So we're going to issue some supplies. Actually, it's a lot of supplies. So it says here, if the budget. Okay, so the budget gives us a markup of 35%. So it's a 35% markup. All right. So if we issue supplies, it costs $185,000. Okay, so if we have, okay, all right, 185. So if our supplies equal $185,000, can you see that? Yeah, you see that. Okay, we're going to multiply it by what? 1.35, and there's that 249,750, right? So you just multiply it by 1.35. That's that 35% markup, okay? So let's look at this. So here is cost. This is like cost of goods sold, but it's going to be cost of supplies issued, right? Here's it being removed from inventory. Right? That's a very simple, straightforward entry that we would be used to, worded differently, but we know what that is, okay? Now down here, due from general. This is like accounts receivable, right? So this is essentially accounts receivable. In billings to departments, that's like sales. Okay, so it's very similar, really, to what we see in a for-profit. It's just worded much differently. Okay, so here is us recording the sale down here, which has the built-in markup, and then you move out the cost of goods sold here. Okay, nothing hard, other than the accounts are way different than we might expect. Okay. Down here, this is the actual payment. So whenever we receive that cash from the general fund, we will subtract it. We will add it to cash, and we will remove that, essentially the accounts receivable. Right? Very good. Down here it says, assuming that payroll, fringe benefits. So these are just, we just want to go ahead and get some expenses in for the year. So it kind of gave us this number of $55,000, and it says here that entry 6 is appropriate. So it's just saying this was our expenses. We're not going to list them out. Here they are. Okay, and you have them all broken down into their individual expense accounts within the fund. Now, within the government activities, we can just put it as general government expenses. Okay, it's a little bit shorter, a little less descriptive, but we got them nice and spelled out nicely in our supplies fund. Okay. Now here, okay, this kind of a strange thing here. The town receives a $1,000 cash grant from the state program promoting the use of these compact fluorescent light bulbs. That's the little spiry light bulbs. That's kind of an old technology now. Right now, it's all LED. You know what I'm talking about? LED? I like LEDs because they don't run as hot. And I think these compact fluorescent light bulbs, even though they're better than the incandescent light bulbs, they're a little. They got some mercury or something in them, so they're a little dangerous. But anyway, so they got a grant to replace their old light bulbs, their old hot light bulbs, the ones that are called incandescent, with these compact fluorescent light bulbs, the little small spirally ones. And so here's where they received the cash from the grant. Okay, so increased cash, increased grant revenue. Here's where they actually did the exchanging of the bulbs. So they got $1,000 worth of expenses to buy the bulbs, and here's the cash to pay for them. Down here, you see it's just done differently within the governmental activities journal. You've got the cash still coming in. Now we're going to call it program revenue, general government, and here's that operating grants and contributions. So different description for revenue, obviously. And then also it's going to be a slightly different expense, a little more general expense listing in the government activity journal. Okay, if payments on vouchers totaled $164 for the year, here would be our entry. Now this kind of ties into this one. We just didn't pay all this off yet, okay? So this is a lot of it, okay? Where we got our vouchers payable, but back down to number 8. We didn't pay it all off, which is fine. Maybe what's it due right there at the year end. So here's our actual, paying down that liability. Okay, there's still going to be some in there in an ending balance at the year end, which is fine. Now here's this. And then number 9 is where we're going to make one of those. We're going to pay that part of that loan back to the water utility fund. And so you see here where we have the first thing we did is lower the current. I hate that it keeps pulling it up. We're going to subtract it from the current debt. And there's the cash to pay for it. And then number 9 is going to reclassify, next year's, which would have been considered long-term, or non-current to current. So we're kind of pulling next year's in because the next year's amount is now current. So we got to take it out of the non-current amount. And then here's this thing again, this internal balances again. We're paying back that internal loan. Okay, so this is where it gets a little confusing. Okay, but ultimately, okay, so this is a debit to internal balances of $6,500. Up here where we set it up, okay, was a credit of $130. So this $130 is essentially what? That's going to be debit balance. Okay, and then after 20 years, we will apply 20 credits of $6,500 a piece, and therefore it'll go away in 20 years. Okay. Where am I at? Right here. Down here. Now, this gets confusing, too, some of this wording here, some of these accounts. Up here it says, if administrative and clerical office space occupies 10% of the area of warehouse, then 10% of the depreciation of the warehouse may be considered an administrative expense. Similarly, if the purchasing office occupies 10% space for the warehouse building, 10% of the depreciation may be considered purchasing expense. So some of this is being spelled out up in here is where to classify it. Ultimately, because it's all depreciation, and you see here, even this is different, right? As opposed to being called accumulated depreciation. Instead, within the fund, we call it allowance for depreciation. So again, it's just more wording issues more than it is difficult accounting concepts. It's just wording is different. Okay, so there's our depreciation. Now we do have some of it classified as administrative and purchasing, as spelled out here. It tells you kind of to do that. But ultimately, these debits equal these credits. And I left that one out, which is also depreciation, right? So these equal these. Within the governmental journal, you see it's actually called accumulated depreciation here. It's called allowance within the fund. Okay, so that's a little something new as well that we got to deal with. All right. Now 11 is closing entries. So you see the reversals. Okay, so if you're going to track this, you'd have to kind of go through all the T's. Allowance is the same. Yeah, essentially it is. Okay. It's just different wording. Now, we'll use the word allowance for depreciation within the supplies fund. Okay? But when you look at those governmental-wide, at the governmental activities journal, we would actually use the traditional accumulated depreciation. Remember, this is called a dual-track approach. How it would look within the supplies fund and how it looks as a general entry within the books of the general government, the general ledger for the entire government. Okay, but good question, right? You got it? Okay, so within the fund allowance for depreciation, within the general journal or the general activities journal, accumulated depreciation. Excuse me. But essentially, yes, essentially it is the same thing as accumulated depreciation. It's an offset to lower the value of your historical cost of buildings, machinery, and equipment, and delivery equipment. Now, what you don't see there, obviously, is allowance for depreciation for land, because, again, land doesn't really depreciate. All right. So, again, these are the closing entries. So, some of these, if you want to, see where the numbers are coming from, you'd have to go up top, probably run some T's, so you can see, okay, like administrative expenses, right? So, administrative expenses, let's track it real quick. I think I know where they are too. Right here. See, here's the 11,000. That is the 11,000 debit. And then in this here, where we put this 350 into administrative expenses as well, and that gives you your 11,350, right? So it's part of it is that depreciation thing, and also the other 11,000 that they told us was the depreciation expense. So some of these, to see the numbers come from, you have to kind of track the other entries above, okay? And then once we get done, so this down here is kind of closing the income. This right here, the best way I can kind of compare that is going to be your income summary, okay? Essentially, that's income summary, all right? If you go back to your for-profit closing entries, that's essentially your income summary. And so the last step of the for-profit method is to close income summary to capital. Now, see, again, we don't have capital here. So here's where your closing income summary, or this excess of billings, excess of revenue to cover costs, okay? That total revenue, we have a revenue situation here, is transferred to improve our net position, okay? That's unrestricted, okay? Now, what's going on down here? I think I forgot to look at this one here. This has got the prior stuff, right? So prior to the financial statement preparation, net position balances will be computed. Supplies fund had investment and capital assets of 122. Oh yeah, there's the accumulated depreciation. There's a negative net investment capital assets. Okay, so this here you got to deal with. What does that say? Less than the balance of the interfund loan. Oh, I see. So after we make our first loan payment, now our loan balance is 123. But our value of our assets is 122, which is what we purchased. So when in the 130 that's where you got the land, the building, the machinery, and the delivery equipment, minus the accumulated depreciation. Let me scroll up one more time right here. Okay, these three numbers here are that $8,000. So essentially, our book value of our assets is 122, and the balance of our loan is 123.5. So that difference is at $1,500 there. Okay, and so that's what you see going on there. Again, I want you can go through the statements. We're going to do some on Wednesday. Okay. So on Wednesday, we'll come back and we'll do some of these statements. We'll do probably some entries too. So Wednesday might be long. I might actually do a Wednesday and a Friday if it gets too long. So we'll see what we come up with on that on Wednesday. I don't want to go like some crazy long 2-hour session. I'd rather split it up. Okay, so they're a little more tolerable. Again, so for Wednesday, if you have not done so, please try to do the Learn Smart. Okay, you may also want to take the book out and review the statements, which are listed here. Here's your essentially your balance sheet. Okay, I think this is probably very close to a balance sheet because there's probably not any deferred. We didn't really talk about any deferred inflows or outflows, so this should be pretty straightforward to look at. This is like the revenue statement you see up here. I got my phone. Here's our, sales essentially. Here's our cost of sales essentially. We even got a gross margin. Here's our expenses. Okay, there you go. And here's our cash flow. Remember, it must be direct. So you're gonna see. Excuse me. You're gonna see those cash received from customers, cash paid to employees, cash paid to suppliers. Okay, using the direct method. All right. So you'll see something similar to that too when you look at the proprietary entries that are in the textbook as well. So for Wednesday, try to get that Learn Smart done if you haven't done so. And also your question for the day, which I have posted, it is posted in Blackboard. It is to name me a proprietary fund that your city or county uses. Okay, and if you can't think of one, like I know two from Orangeburg, city of Orangeburg. Nice and easy, right? Hillcrest Golf Course, Department of Public Utilities. Okay, so if you can't think of one, okay, then you need to go to the statements, the financial statements, and you should be able to find in there some listings of proprietary funds within your city or county. All right, just one from either city or county is fine. I'm not trying to kill you with these questions. It's just a way of verifying attendance that you've kind of watched the video, right? Or you're actively trying to get your governmental class completed. All right, guys. So until next time, until Wednesday, we have some problems. Do the Learn Smart, and we'll talk to you then, guys. Have a great 2 days. I'll be back Wednesday for some problems. Where's my stuff at? All right. See you then. God bless.